On YouTube, the case for passive investing has been made clear through a number of mainstream channels, ranging from Graham Stephan to Andre Geek, including Ramin from PensionCraft. I myself posted a video 1 year ago explaining the pros and cons of passive investing. If you're new to investing and want to understand why index funds are so popular, be sure to check out my video here. Link is also in the description below. In summary, passive investing refers to a minimal effort style of investing where you can just put your money into a fund and let it grow over time. There's no need to stay on top of short-term information about specific companies because the goal is to grow your capital over the long run. Index funds are ideal for this strategy because they are designed to track an index and adjust accordingly. And because it's relatively easy to track an index, this is also why management cost or expense ratio of the fund tends to be low. And that's another advantage of passive investing. The other argument made against active investing is that in the long run, active funds tend to underperform passive funds, especially when active management costs are taken into consideration. In economic theory, passive investing has a lot of supporters, ranging from Nobel Prize winner Eugene Fama to Markowitz's modern portfolio theory. Fama's underpinning theory is efficient market hypothesis, which effectively states that all information is known and therefore stock prices reflect the true value of the share. In other words, there's no room for over or undervaluation. This view is controversial as we know for a fact that many assumptions underpinning many economic theories simply don't translate to the real world. And assumptions are necessary foundations to build elaborate mathematical models. But the true power of any model, and I really mean any model, is the ability to explain or predict what is happening or what would happen. Now this is the true litmus test. If the model is not able to predict the outcome, then no matter how nice and beautiful the theory is, you have to throw it out of the window. At least that's what natural scientists do, such as physicists or chemists. And there are lots of beautiful theories which didn't make the cut. Okay, I digressed a bit, but back to the efficient market hypothesis. The typical assumption of rational investors and perfect information means that bubbles shouldn't exist, and that Tesla's valuation compared to Toyota's arguably defies conventional rationality. Furthermore, the very existence of speculative investing like precious metals or cryptocurrencies goes against the fundamental principles of the efficient market hypothesis. This is because the asset value is purely driven by demand and supply with little inherent value, as opposed to a stock which has a value based on expected present value of dividends or book value or some other measure. Also, if the prices reflected all information already, then stock prices wouldn't change following the annual report release or react to certain news. Therefore, we know for a fact that the efficient market hypothesis at the very least does not explain every situation, and at the very worst holds no basis for reality. I personally think elements of the efficient market hypothesis is happening to some extent in the background, but is not always prevailing as other factors start to come to play. Warren Buffett is arguably the greatest investor of all time, defies the efficient market hypothesis. And is Cathie Wood the next Warren Buffett? Who knows, only time will tell. And while empirically it's true that index funds have outperformed most active fund managers, that also means there are some active managers who have consistently beaten the index, although these are in the minority. In other words, pick your fund manager carefully because the odds are against him. So does that mean active management is dead? And basically you should steer clear of active funds? I'll answer this question in my next video. That's it for me this week. Please click on the like button and show your appreciation, and remember to subscribe if you'd like to be notified about the second part. As always, thanks for watching.